The onset of a recession puts any investment portfolio in trouble. While it's impossible to predict with certainty what will happen in the market or economy, investors can still focus on what they can control. The best recession-proof stocks are able to weather high inflation and rising interest rates that threaten to push the economy into recession in 2023. Ready to find out the top 4 recession-proof stocks? Before we understand what sectors and types of stocks are worth investing in, let's start with the question, what is a recession? When a country has 2 quarters of negative growth, it means that the country is in a recession, but that creates a whole new set of problems. In a recession, the stocks with the highest dividends have pricing power to resist cost inflation, low leverage to protect against higher interest rates, and high-yield commodities. The best recession-proof stocks are able to weather high inflation and rising interest rates that threaten to push the economy into recession in 2023. The Federal Reserve's aggressive rate hikes, persistent inflation, and the recent US credit rating downgrade have investors worrying about a possible recession. When the economy collapses, most high-quality stocks follow suit. However, in the previous recessionary years in 2008 and 2020, some stocks still outperformed the S&P 500. These recession-proof stocks could help protect investors if the US plunges into recession in 2023. Forbes Advisor has recently identified 9 recessionary stocks that are best suited for your investment portfolio. They're all from defensive sectors, show steady growth, and outperform 90% of stocks during the bear market that usually accompanies a recession. Among the companies hardest hit by the recession are the consumer staples, utilities, and healthcare sectors, which produce goods and services that consumers cannot do without, regardless of the state of the economy. Here, we'll give you a heads up on some of these stocks. Number 1. Walmart Inc. No matter what economic period the economy is in, people could not live without certain things. Even if people stopped spending money on expensive restaurants, they would still buy essential groceries. People still have to take care of themselves and buy toothpaste, soap, cleaning shampoo, dish soap, and more. Since these products are always in demand, regardless of the economic environment, they're referred to as consumer staples. This sector is usually the first choice when it comes to investing during a recession. In general, discounters do better in many recessions. Consumers always need places to buy their everyday essentials, and when budgets are tight, getting the best price becomes even more important. Even during the first wave of COVID-19, Walmart has held up well in tough economic times. Unsurprisingly, Walmart has outperformed in each of the last 2 years of the recession. Americans can't go without groceries during tough times, but they can save money by getting great deals at Walmart. Analyst Aaron Sundaram says Walmart has plenty of growth levers to leverage in 2024 to sustain its recent positive operation momentum and expand margins. According to Sundaram, Walmart's e-commerce business has reached an inflection point in terms of profitability, and higher margin businesses like third-party marketplaces and advertising are outpacing its core retail business, Walmart's physical retail business. CFRA has a buy rating and a price target of $175 on WMT, which traded at $157.51 on August 21st. Number 2. Abbott Laboratories. Pharmaceutical stocks, a subsector of the healthcare sector, have traditionally been viewed as defensive along with other sectors such as utilities. Even in the face of economic crisis, people need medicines and cures for diseases. For example, if you take blood pressure medication, you're unlikely to stop taking it when the recession hits. You're more likely to continue taking your medication, even if you have to find a new way to pay for it. This and many other examples show why healthcare stocks can still be a good deal in the face of an economic downturn. Abbott Laboratories is a diversified healthcare products company. It's understandable that many healthcare stocks have performed well during the 2020 pandemic, but Abbott shares performed even better in 2008. According to analyst Paige Mayer, Abbott's diversified business model, strong balance sheet, and growing dividends will help the stock outperform other companies over the long term. Mayer estimates that the COVID-19 related sales decline will cause Abbott sales to fall 9% in 2023, but Mayer says investors should expect a return of 5% sales growth in 2024. The CFRA has a buy rating and a target price of $130 for ABT shares, which closed on August 21st at $103.87. During the previous recessions in the early 1990s and 2000s, as well as during the 2008 financial crisis, the pharmaceutical industry was also hit by the recession. However, pharmaceutical companies can capitalize on this inherent resilience in times of recession by following 3 principles: boost growth, optimize their portfolio, and control costs. Number 3. Synopsys Inc. Precious metals like gold and silver are often in demand during stock market sales and during times of general economic turmoil. And now rare earth metals too come under this head because they determine the future now. This is because precious metals are considered a store of value, something tangible investors can physically hold onto when their intangible assets, like stocks, fall in value. Gold also tends to rise in low interest rate environments. Since gold doesn't pay dividends, it becomes more attractive when other instruments aren't very profitable either. Synopsys provides a platform on which engineers design and test semiconductor chips and other applications. The global semiconductor industry is a secular growth market, so the demand for integrated circuit design and test services remains constant even in times of economic downturns. According to analyst Garrett Nelson, Synopsys is a leader in AI technology for automating electronic design, allowing the company to grow revenue with existing customers after 3-year contracts expire. Nelson also says he's confident about future CEO Sassine Ghazi. CFRA has a strong buy rating and an S&PS target price of $495, trading at $436.47 on August 21st. Looking at the silicon cycle since 2000, semiconductor recessions have never lasted more than a year. From this point of view, the semiconductor market will certainly grow positively again in the near future. Number 4. Accenture plc. Tech stocks aren't always considered a classic defense measure during a recession. However, with so many people around the world working from home more than ever before, technology has so far proven to be an important and thriving node. Whether it's watching Netflix, ordering from Amazon, or connecting with friends, family, and co-workers via Zoom, many tech companies are holding up well and will be good choices over the long term. One of the best examples after the corona crisis was Zoom. This technology has enabled many businesses to operate during lockdown. As a result, the company's shares rose many times over. Nowadays, many companies operate entirely online. It turns out they had to deal with more baggage handlers during the corona crisis as their work was not affected. Accenture is a global IT services company. The company generates almost half its sales in North America, about a third in Europe, and the rest in other regions of the world. Accenture's diversified consulting and services businesses have made the company recession-proof in the past and likely will remain so in the future. According to analyst Keith Snyder, Accenture's large client base, impressive balance sheet, and industry-leading track record will help the company survive well in uncertain macroeconomic environments. CFRA has a strong buy rating and a target price of $341 on ACN, which traded at $306.51 on August 21st. There are a number of daily habits you can adopt to protect yourself from a potential economic downturn or recession. An emergency fund, good credit, multiple sources of income, and living within your means are all important tools that can help you navigate a tough economy financially. When it comes to investing, preparing for a recession requires taking a long-term approach to your investment goals, diversifying your investments, and being realistic about your risk tolerance. The key to recovering from a recession is planning for the worst-case scenario. So, be wise of your investments during the period of recession. Take the help of a financial advisor as a safeguard. We'll come up with a related video on the same, and you can trust us with the reliable information we provide. Until next time, take care and goodbye.